Welcome to Alpha Recap. I'm glad you could join us. We're unpacking the key market moves from Friday and what they mean for different investors. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Lots to cover. Corporate shakeups, earnings beats, and some quiet macro action underneath it all.
Let's start with the big headline everyone was talking about. A major streaming name reported first quarter profits that smashed expectations, and its co-founder announced he was stepping away. What did you make of that combination?
It was interesting. On the surface, the quarter showed faster subscriber adds and the benefit of a recent price increase. Those are real operational positives. But there was also a one-time boost, a breakup fee that landed in the quarter and materially inflated net income.
Okay, slow down for a second. How big was that one-time item?
It was about $2.8 billion. That's not trivial. It flowed into net income in the quarter, which helps the headline earnings number look much stronger than recurring operations alone would have produced.
So that's the classic headline versus underlying question.
Exactly. Analysts will now strip out that $2.8 billion when they model adjusted earnings per share and free cash flow to get at sustainable trends like subscriber growth and average revenue per user.
And the founder leaving? Did markets read that as bad news or a sign of maturity?
A mix. Management framed it as a signal the company doesn't need its founding public face to keep growing. Some traders saw that as neutral to positive, especially given the beat. Others flagged governance and succession questions. So the story was nuanced.
Right. Moving on. The pre-market tone showed mild risk appetite. Broad market ETFs were up by about 0.3%. How should we interpret that going into the earnings stretch?
That kind of uptick typically reflects tactical positioning. Traders were buying an index exposure ahead of a heavy earnings slate, not necessarily a macro breakout. It often means hedged positioning, which can keep overall volatility low, but leave space for big single-stock moves when companies report. Right.
Let's talk about a big winner in biotech that stood out. A certain biotech company finished the day around $583.82 after huge multi-year gains. Walk us through that.
That company showed concentrated strength, about 186% over 5 years and roughly 35% in the last 6 months. It's a great example of dispersion, where individual names, especially in biotech, can massively outperform the broader market because of binary catalysts, product cycles, or trial results.
So concentrated return, higher idiosyncratic risk.
Exactly. For anyone building a portfolio, that means security selection mattered a lot. But it also means that volatility and event risk are higher around those names.
Speaking of risk, treasuries and the dollar were described as stabilized. There were also a number of corporate filings that could create idiosyncratic moves. How did those two forces interact?
When treasuries and the dollar calm down, rate-driven volatility eases, and you don't see huge swings in rate-sensitive sectors. That tended to keep the market range-bound. Meanwhile, corporate disclosures, 8K filings, delisting notices, governance items, acted as the main source of headline risk in individual names. So overall, market volatility remained muted, but there were local spikes tied to specific filings.
One of those corporate moves was a delisting notice for a smaller company, and others included operational filings from regional banks and auto suppliers. That's the kind of thing that can catch traders off guard, right?
Definitely. Delisting notices can crush liquidity and re-rate a stock fast, and filings by banks or auto suppliers can meaningfully change operational outlooks. It's classic event-driven volatility.
Quick reaction segment, short takes. Was Friday more about headline momentum or a cautious market?
Headline momentum with a cautious macro backdrop. Yeah, that tracks.
Another notable twist? A major bank publicly turned bearish on a long-standing consumer staples name. That felt like an unusual downgrade. Thoughts?
It was notable because staples are often seen as defensive. The bank flagged margin and demand pressure, which prompted a re-rating. Analysts are debating whether this is a structural issue for staples or a near-term profitability pressure. Either way, it reminded people that defensive, dividend-oriented names aren't immune to downside revisions.
Which brings us to that ongoing debate: headline beats versus earnings quality. How should listeners think about distinguishing the two?
Simple framework. Ask if the reported gain reflects recurring operational cash generation or a one-off accounting inflator. Breakup fees, legal settlements, large asset sales, those are one-offs. Analysts typically look at adjusted metrics that exclude those items to assess durability.
So when you see a big headline beat on a quarter, the follow-up is to look at adjusted earnings, subscriber trends, and free cash flow excluding one-offs.
Exactly. And watch management commentary on sustainability. If subscriber growth or average revenue per user is accelerating without one-offs, that's more meaningful.
Let's pivot to fixed income choices. There was a simple trade-off presented between pure short-term Treasury exposure and a broader short-term bond mix that includes some investment-grade credit. How should conservative investors think about that?
It boils down to priorities. If principal stability and minimal credit risk matter most, pure Treasury short-term exposure is usually preferable. If you want a little more yield and can tolerate modest credit exposure, a short-term mix with investment-grade bonds may be reasonable. With Treasuries stabilized, many conservative managers leaned toward Treasury safety, but it's a preference call.
Short reactions.
Principal safety first for many.
Yeah, absolutely.
Right.
There was also an interesting nod toward embodied AI and commercialization. One company called it Deployment Year One at a conference. Even though it wasn't a public company, analysts linked that to the hardware and robotics supply chain. What's the practical takeaway?
The practical takeaway is that pilot projects moving toward commercialization can lead to real revenue sooner than people expect, but the path is still uncertain. For public companies in the supply chain, chip makers, robotic systems providers, these signals can create correlated upside if contracts and revenue recognition follow. But without public financials from the company making the announcement, it's mostly directional, not definitive.
So follow-through matters. Contracts, partner disclosures, and revenue recognition.
Exactly. Press releases about deployments are interesting, but investors want to see recurring revenue lines and confirmed partners.
Let's close with what this meant for different investor types. Walk me through the implications for long-term holders, income investors, conservative managers, tactical traders, and speculative tech watchers.
Long-term holders should focus on stripping out one-offs when modeling future cash flows and watching subscriber and ARPU trends. Income investors need to reassess payout coverage and margin sensitivity, especially after that Staples downgrade. Conservative managers should align short-term bond choices to their principal protection goals. Tactical traders saw opportunity in pre-market ETF flows and the slew of 8K filings. Those create event windows, but also execution risk. And speculative tech and AI investors should look for revenue-related proof points after deployment announcements, before assuming the hype will translate into durable earnings.
Perfect. Quick final segment. 3 takeaways in plain terms.
1. Headline earnings matter, but adjust for one-offs like that $2.8 billion breakup fee. 2. Markets finished with selective risk appetite, tactical positioning rather than broad conviction. 3. Corporate filings and idiosyncratic events were the main sources of volatility at the security level.
Great summary. A reminder, our discussion is for informational purposes only and not personalized investment advice. Analysts note trends and data, but we are not recommending specific actions.
Right. Objective analysis, not advice.
Thanks for that, and thanks for joining me today.
My pleasure. Good to walk through how earnings and one-offs were steering the market tone.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll see you next Market Wrap.